Hello there. What's going on, YouTubers? Um, at long last, I suppose I've got some time and fairly adequate opportunity to go through, to run you guys through, the book called Investments, authored, I should say co-authored by Bodie, Kane, and Marcus. Apparently, they all teach in world-class, prestigious universities, either from the University of Chicago or Boston, blah blah blah. Well, so far as much as I can perceive and recognize, it's a fairly straightforward place to start with learning how to invest, how to develop some fundamental and fairly comprehensive knowledge and skills pertaining to making investments, pertaining to how to generate a bit of passive income, without actually having to work a 9 to 5 job just over broke. The reason why I kind of chose to start systematically learning how to invest from this book is because I found so far this book the most comprehensive and yet rather straightforward one to start with, for laymen, for absolute amateurs and noobs like me, and as you guys might have already well known that I don't really have much background knowledge for finance, for economics, for the knowledge about money, and therefore I don't actually have that sort of solid foundation when it comes to making investments, making monetary investments for the sole purpose of more and more monetary gains or capital gains and blah blah blah. But since I have some free time, why not try to invest this or try to convert this amount of free time by learning things, by learning a skill that can benefit both of us in the long run, instead of fapping, gaming, browsing pornos and fab to them, or banning my sex doll and blah blah blah, and indulging in some weird and perverted fantasies. Why not try to force my mind into another flow state, and in the meantime I come up with something more worthwhile, something more productive, and that also enables me to get to enjoy the music along the way. Though I'm not sure, though I'm not sure if this video could get taken down by YouTube, due to copyright violations or infringements. But I will try my best, to make it as legal and ethical as I can, since I've already attached, a logo of fair use and a rather lousy and blurry screenshot from the government, from the British government's website pertaining to exceptions of copyright, characterized by free use, in the purpose of academic research or criticisms, or just some sort of studying, casual studying instead of the so-called formal research or whatnot. But and a disclaimer here: I am not a qualified financial advisor or banker, nor I don't consider myself an adequate person to go to ask for financial advice or any sort of professional recommendations pertaining to financial or legal matters per se. So do bear in mind to do your own due diligence of homework and research beforehand, before you actually commit and risk your hard-earned money to the ever-changing global markets of investments and some other sorts of entrepreneurial or business undertakings. So do bear that in mind. I humbly ask you guys to always bear that disclaimer in mind. Thank you very much. So本題、早速本題に移りましょうか。So let's 早速本題に移りましょうか。Let's get back to the main topic of this filming session. So I like to read and review a bunch of texts, some selected texts and chapters of this book that I'm showing you here. Whose book cover I'm showing you right now. It's a book, well, as the title suggests, it should sound and seem rather self-explanatory to you guys already. So I would like to begin with chapter 20 a bit. I'm not going through the whole chapter, since it contains plenty of charts, plenty of equations, and some mathematical models that I found rather difficult to just vocalize and put in plain words, to in the form of narration or whatnot. So without further ado, let us read and ruminate about the introduction of this particular chapter. Let's dive in a bit to see what it brings us and how it benefits us in the end. So chapter 20, Options Markets, Introduction. Derivative securities, or more simply derivatives, play a large and increasingly important role in financial markets. These are securities whose prices are determined by or derived from the prices of other securities. Options and futures contracts are both derivative securities. Their payoffs depend on the value of other securities. Swaps, which we will discuss in chapter 23, also are derivatives, because the value of derivatives depends on the value of other securities. They can be powerful tools for both hedging and speculation. We will investigate these applications in the next 4 chapters, starting in this chapter with options. Trading of standardized options contracts on a national exchange started in 1973 when the Chicago Board Options Exchange, aka CBOE, began listing core options. These contracts were almost immediately a great success, crowding out the previously existing over-the-counter options market. So a bit of rather boring, but a factual side note slash anecdote here. I used to kind of perceive option markets equal to trading all sorts of commodities on online, but since I first for this first time I got to know such words, such fancy terms, such fancy terminology, such fancy financial terminology back in the days. When I still didn't think and speak English as my first language. In fact, the Mandarin Chinese translation of such term, seems and sounds rather vague and kind of misleading, more or less. So I kind of I only like most recently, say a couple of days, a couple of weeks ago, had I begun to learn the most appropriate, the most serious, the most accurate and the most academically rigorous definition for the option, for the term option, for the term bracket financial or trading options, in terms of investments, in terms of finance and whatnot, so that kind of teaches me a lesson, that taught me an important a critical lesson, about life, about learning, in general. Never judge a book by its cover. That says never judge a person based on their physical appearances and their ethnicities or nationalities, blah blah blah. So yeah. Next we have option contracts are traded now on several exchanges. They are written on common stock indexes, foreign exchange, agricultural commodities, precious metals, and interest rate futures. In addition, the over-the-counter market has enjoyed a tremendous resurgence in recent years as trading in custom-tailored options has exploded. Popular and potent tools in modifying portfolio characteristics, options have become essential tools a portfolio manager must understand. This chapter is an introduction to options markets. It explains how puts and calls work and examines their investment characteristics. Popular option strategies are considered next. Finally, we examine a range of securities with embodied options such as callable or convertible bonds, and we take a quick look at some so-called exotic options. Yeah, so there are a bunch of other sections and parts throughout the whole chapter. And there's a case for derivatives in this chapter, and some graphs, some charts, some equations, blah blah blah. But I will just read through, read through and give you guys my reviews, my thoughts on the mostly texts, and I shall omit, the questions and the exercises. Yeah, despite the problem sets divide themselves into two groups: the basic ones and the intermediate ones. Yeah, that's I suppose we shall try to practice with them, try to experiment with them, during our spare time, at our own pace. They aren't really that interesting, to go through in a filming session. In a video clip, I would like to keep as brief and concise as possible. So yeah, let's resume. Well, it's not like they came up with plenty of colorful and vivid charts and illustrations, that are interesting to stare at and to ruminate about. Beg your pardon. It's a bit long. It's a bit tedious, yeah, right? In any regards, yeah. So yes, next we have chapter 20.1, the option contract. A call option gives its holder the right to purchase an asset for a specified price, called the exercise or strike price on or before some specified expiration date. For example, a February call option on IBM stock with exercise price $195 entitles its owner to purchase IBM stock for a price of $195 at any time up to and including the expiration date in February. The holder of the call is not required to exercise the option. She will choose to exercise only if the market value of the underlying asset exceeds the exercise price. In that case, the option holder may call away the assets for the exercise price. Otherwise, the option may be left unexercised. If it is not exercised before the expiration date of the contract, a call option simply expires and becomes valueless. Therefore, if the stock price is greater than the exercise price on the expiration date, the value of the call option equals the difference between the stock price and the exercise price. But if the stock price is less than the exercise price at expiration, the call will be worthless. The net profit on the call is the value of the option minus the price originally paid to purchase it. Okay, so an option contract seems to have a date of expiry, yes, though in the text, in the book, it's called the expiration instead of an expiry date. I'm not sure about the subtle differences, in terms of the nuance or whatnot, or context. But it seems rather identical to me, at least at this point. Well, we shall get back to that, if later, if God willing. Yeah. So yeah, let's resume. Oops. Where else do we have? The purchase price of the option is called the premium. It represents the compensation the purchaser of the call must pay for the right to exercise the option only when exercise is desirable. Sellers of call options who are set to write calls receive premium income now as payment against the possibility they will be required at some later date to deliver the asset in return for an exercise price less than the market value of the asset. If the option is left to expire worthless, the writer of the call clears a profit equal to the premium income derived from the initial sale of the option. But if the call is exercised, the profit to the option writer is the premium income minus the difference between the value of the stock that must be delivered and the exercise price that is paid for those shares. If that difference is larger than the initial premium, the writer will incur a loss. That's a bit hard for me to comprehend at this point. But immediately after these lines of text, the author gave an example, marked example 20.1, profits and losses on a call option. Consider the February 2013 expiration call option on a share of ABM with an exercise price of $195 selling on January 18th, 2013 for $3.65. Exchange traded options expire on the third Friday of the expiration month, which for this option was February 15th. Until the expiration date, the call holder may buy shares of IBM for $195. On January 18th, IBM sells for $194.47. So basically, it's devalued. Because the stock price is only $195.47, it clearly would not make sense at the moment to exercise the option to buy at $195. Indeed, if IBM remains below $195 by the expiration date, the call will be left to expire worthless. On the other hand, if IBM is selling above $195 at expiration, the call holder will find it optimal to exercise. For example, if IBM sells for $195 on February the 15th, the option will be exercised, as it will give its holder the right to pay $195 for stock worth $197. The value of each option on the expiration date would then be value at expiration. Value at expiration equals stock price minus exercise price. $195 minus $197 minus $195 equals $2. Despite the $2 payoff at expiration, the call holder still realizes a loss of $1.65 on the investment because the initial purchase price was $3.65. Profit equals final value minus original investment, which is $2 minus $3.65 equals minus $1.65. Okay, that still doesn't quite make sense to me. Perhaps I should go back to some of my A-level textbooks to review and recall some of my forgotten knowledge and principle about business, about economy. about economics. If or maybe I just fapped too much. I don't know if you guys I don't know if you guys caught the drift as to why there was there was a $1 there was a $1.65 loss if the call holder in this example example 20.1 suffered a loss of such amount, so let's read that again. Consider the February 2013 expiration call option on share of IBM with an exercise price of $195, selling on January 18th, 2013 for $3.65. Exchange traded options expire on the third Friday of the expiration month, which for this option was February the 15th. Until the expiration date, the call holder may buy shares of IBM for $195. On January, IBM sells for $194.47. Because the stock price is only $194.47, it clearly would not make sense at the moment to exercise the option to buy at $195. Yeah. So far here it makes sense to me, but it starts from it starts from here. Wait. Yeah. Because the stock price is only indeed, if IBM remains below 195 by the expiration date, the call will be left to expire worthless. So yeah, if you don't see an immediate capital gain or profit by exercising the option to buy that call option at 195, then it's pretty much worthless. Yeah, at least to the buyer. But I'm not sure whether it can do more. It can make more profit, to the issuer, of that, or the host or third party host of that trade. I don't know, but yeah. But in any regards, let's keep reading. Indeed, if IBM remains below 195 by the expiration date, the call will be left to expire worthless. On the other hand, if IBM is selling above $195 at expiration, the call holder will find it optimal to exercise. For example, if IBM sells if IBM sells for $195 on February the 15th, the option will be exercised, as it will give its holder the right to pay $195 for stock worth $197. The value of each option on the expiration date would then be value at expiration equals to stock price minus exercise price, which is $197 minus $195, which equals $2. Despite the $2 payoff at expiration, the call holder still realizes a loss, or suffers a loss of $1.75 or $1.75 on the investment, because the initial purchase price was $3.65. Yeah. Oh, now it makes sense to me. Yeah, since it's now the author mentioned, the buying price, at which the caller chose to buy such call option, at $3.65. Yeah, in the very beginning of this example here. So yeah, so that will be $2 minus $3.65, which makes the the investor or the call holder suffer a loss, just a minor loss, not a tremendous loss, a minor loss of $1.65. Yeah. Oh yeah, now it makes sense to me. So yes, and whenever you consider whether to buy some sort of stock, or whether some sort of bonds, or sort of corporate bonds, or governmental bonds, whatnot, whatever, also take into the the fees, the fees that that will get deducted and cleared, at the end of such or each and every transaction you make through via their platform, or via any sort of third-party platform, or if you can't, you own and run the platform, you can that says you can exercise and exert a total and sovereign control on that platform, in which you trade the core options or stocks or whatnot, or whatever sort of financial investments options, then scratch that. If that be the case, then you don't actually have to take the platform fees into consideration, most of the times, well, if you that says, if you do fully comply with the commandment of control, from the book, from another book titled The Millionaire Fastlane, which not so long ago previously I read and reviewed. So yeah, that will be the case. So investments, a profitable, a beneficial, and a profitable investment has to occur under the contexts in which you do and you can exercise a full and complete degree of your control. Yeah. So far, that's what I learned, and that's how I interpret, what the authors here are trying to convey, or trying to teach, their readers or learners or students, who hope to learn about how to invest and make some fortune. Yeah. Excuse me. So next we have options trading. Yeah. Maybe I will stop at the option. I will stop this filming session after we finish reading and reviewing, the section that comes after the next section, which is titled options trading. Yeah. So next we have nevertheless exercise of the call is optimal at expiration if the stock price exceeds the exercise price, because the exercise proceeds will offset, excuse me, nevertheless, exercise of the call is optimal at expiration if the stock price exceeds the exercise price, because the exercise proceeds will offset at least part of the purchase price. The call buyer will clear a profit if IBM is selling above $195.65 at the expiration date. At that stock price, the proceeds from exercise will just cover the original cost of the call. But the authors did not provide another example to further illustrate and clarify these lines of texts. Yeah, that's kind of a shame. I don't know if the authors just didn't bother to provide another example. Just because they got super lazy, duper lazy, or just or for some other reasons. But yeah, it's kind of funny, when you start to ruminate, to think about things pertaining to people's motives when it comes to laziness. When it comes to why they when it comes to you would like to, you feel curious to find out exactly why they chose to omit certain parts of examples or further illustrations or elaborations or explanations that they should have provided or come up with. Yeah, that kind of also reminds me of another rather funny scene in Mass Effect. In the first trilogy of Mass Effect, Ashley Williams said a line, "Wait, you survived because you were lazy?" Yeah. That's where Ashley Williams said to a warehouse worker of some sort, in such a tone, wait a minute, you survived because you were lazy?" That's kind of funny. Yeah, that's kind of funny. Yeah. Yes, that warehouse worker managed to survive a Reaper invasion because he chose to he hid himself from his superiors, from his boss, behind some craters to take some naps during his shift. Yeah, that's kind of funny. Yeah. But still, yeah. Oops, why the music stopped? I think my VPN connection dropped. Zvi Bodie. In any regards, yeah. Yes, in any regards. In any regards, yeah, here it says let's change a server connection here. So connect to a different server. Connect to a server allegedly situated in Taiwan. Yeah. Oh, okay. Here we go. Here we go again. Yeah. So, a put option gives its holder the right to sell an asset for a specified exercise or strike price on or before some expiration date. A February expiration put on IBM with an exercise price of 195 entitles its owner to sell IBM stock to the put writer at a price of $195 at any time before expiration in February, even if the market price of IBM is less than $195. Whereas profits on call options increase when the asset price rises. Profits on put options increase when the asset price falls. A put will be exercised only if the exercise price is greater than the price of the underlying asset. That is, only if its holder can deliver for the exercise price an asset with market value less than that amount. One doesn't need to own the shares of IBM to exercise the IBM put option. Upon exercise, the investor's broker purchases the necessary shares of IBM at the market price and immediately delivers or puts them to an option writer for the exercise price. The owner of the put profits by the difference between the exercise price and market price. Okay, need to switch back to the screen. Oh, that's lo-fi music. Yeah. Okay, so give me a sec. Beg your pardon. Just take some screenshot. Oops. Yeah. So what do I make out of this? Well, to tell you the truth, I kind of let my mind wandered and drift away, but from what I can interpret and perceive and understand, that's basically how those brokers or agencies make a profit, as the authors here put at the end of this paragraph. Upon exercise, the investor's broker purchases the necessary shares of IBM at the market price and immediately delivers or puts them to an option writer for the exercise price. The owner of the put profits by the difference between the exercise price and market price. And immediately following that paragraph, we have another example. Example 20.2, profits and losses on a put option. Okay, let's see. Let's dive in. Now consider the February 2013 expiration put option on IBM with an exercise price of $195, selling on January 18th for $5.00. Yeah. It entitled its owner to sell a share of IBM for $195 at any time until February the 15th. If the holder of the put buys a share of IBM and immediately exercises the right to sell it at $195. Net proceeds will be $195 minus $194.47 equals $0.5. Obviously, an investor who pays $5 for the put has no intention of Obviously, an investor who pays $5 for the put has no intention of exercising it immediately. If, on the other hand, IBM was selling for $188 at expiration, the put would turn out to be a profitable investment. Its value at expiration would be value at expiration equals exercise price minus stock price which is $195 minus $188 equals $7. And the investor's profit would be $7 minus $5 equals $2. This is a holding period return of $2 divided by $5. Yes, $2/$5 equals 0.40 cents, or 40% over only 28 days. Obviously, put option sellers on January the 18th, who are on the other side of the transaction, did not consider this outcome very likely. Let's try to make sense. Of this thing. Yeah. So I just need to look up something on Google here. Okay, so make sense of something or make sense out of something means exactly the same. Okay. Yeah, that still seems rather confusing to me. Kind of, in turn, which in turn, exacerbates my OCDs. But regardless, yeah, let's dive in. Let's resume learning. So in the beginning of the example 20.2, profits and losses on a put option. We have, so the seller now consider the February 2013 expiration put option on IBM with an exercise price of $195, selling on January 18th for $5.00. It entitled its owner to sell a share of IBM for $195 at any time until February the 15th. If the holder of the put buys a share of IBM and immediately exercises the right to sell it at $195, net proceeds will be $195 minus 194.47 equals $0.5 Obviously, an investor who pays $5 for the put has no intention of exercising it immediately. Blah blah blah, blah blah blah. But I don't see where that number came from. It quotes. Oh, okay. So it quotes the number from the previous example. Yeah. $194.47. Okay. In example 20.1, profits and losses on a call or option. Yeah. The stock price is this number, this amount, $194.47. Okay. Okay, that starts to make a bit of sense to me, but not fully sensible anyway. Yeah, let's commit first, figure it out later. Yeah. As Uncle Grant Cardone puts it. Yeah. So an option is described as in the money. An option is described as in the money when its exercise would produce a positive cash flow. Therefore, a call option is in the money when the asset price is greater than the exercise. Therefore, a call option is in the money when the asset price is greater than the exercise price. and the put option is in the money when the asset price is less than the exercise price. Oh, okay. So it further elaborates the essential difference between a call option and a put option when it comes to whether they are in the money or out of the money. And then immediately following this, we have conversely, a call is out of the money. A call is out of the money when the asset price is less than the exercise price. No one would exercise the right to purchase for the strike price an asset worth less than the amount. A put option is out of the money when the exercise price is less than the asset price. Options are at the money when the exercise price and asset price are equal. Doesn't that mean they break even? I'm not sure about this. The difference between how breaking even and options sits at the money differs from one another. I don't know yet. But then we have it has yes. The book now presents a figure 20.1 stock options on IBM closing prices as of January the 18th, 2013. Source: the Wall Street Journal Online, January the 18th, 2013. Okay. So it came from the Wall Street Journal Online. That says, the printed version of the Wall Street Journal can still vary from the online version. That kind of implies, my imaginations and speculations here, but that qualifies for another video at a later time where Dave, God still willing. Anyway, we have okay. Oops. We have options trading. Some options trade on over-the-counter markets. The OTC market offers the advantage that the terms of the option contract, the exercise price, expiration date, and number of shares committed can be tailored to the needs of the traders. The costs of establishing an OTC option contract, however, are higher than for exchange-traded options. Options contracts traded on exchanges are standardized by allowable expiration dates and exercise prices for each listed option. Each stock option contract provides for the right to buy or sell 100 shares of stock, except when stock splits occur after the contract is listed and the contract is adjusted for the terms of the split. Standardization of the terms of listed option contracts means all market participants trade in a limited and uniform set of securities. This increases the depth of trading in any particular option, which lowers trading costs and results in a more competitive market. Exchanges offer two important benefits: ease of trading, which flows from a central marketplace where buyers and sellers or their representatives congregate, and the liquid secondary market where buyers and sellers of options can transact quickly and cheaply. I'm not sure what quantitative easing would do options trading market. I feel a bit of curious to know how quantitative easing, can affect options trading. Overall speaking, yeah. Until recently, most options trading in the United States took place on the Chicago Board Options Exchange. However, by 2003, the International Securities Exchange, an electronic exchange based in New York, displaced the CBOE as the largest options market. Options trading in Europe is uniformly transacted in electronic exchanges. Figure 2.1 is a selection of listed stock option quotations for IBM. The last recorded price on the New York Stock Exchange for IBM shares was $194.47 per share. Footnote here. We've got the footnote here. I shall read it. Yeah, I shall read it later. Yeah. So on this figure we have prices at close January 18th, 2013. Okay, and so the price. So that price is an actual one at that time. Apparently, the authors here, didn't claim that they just made up or fabricated a price out of vacuum or from their imaginations, from their wild imaginations. They have some evidence to back up, to authenticate, to verify their sayings as a matter of apparent fact, at least under the context of this book we are talking about here. Yeah. So the footnote number 1 on this page says, occasionally this price may not match the closing price listed for the stock on the stock market page. This is because some NYSE stocks also trade on exchanges that close after the NYSE. And the stock pages may reflect the more recent closing price. The options exchanges, however, close with the NYSE, apparently the New York Stock Exchange. So the closing NYSE stock price is appropriate. So the closing NYSE stock price is appropriate for comparison with the closing option price. Okay, I don't know why the author says so. Why are they appropriate for comparison with the closing option price here? And they have no further examples or evidence to back up this, this footnote. Yeah, but we shall, investigate that later. If I have more time, more energy, more strength, and if God still willing, most importantly. What else do we have? Figure 20.1 is a selection of listed stock option quotations for IBM. The last recorded price on the New York Stock Exchange for IBM shares was $194.47 per share. The exercise or strike price of the exercise or strike prices bracket the stock price, while exercise prices generally are set at 5-point intervals. Larger intervals sometimes are set for stocks selling above $100, and intervals of $2.50 may be used for stocks selling at low prices. If the stock price moves outside the range of exercise prices of the existing set of options, new options with appropriate exercise prices may be offered. Therefore, at any time, both in the money and out of the money options will be listed, as in this example. Figure 20.1 shows both call and put options listed for each expiration date and exercise price. The three sets of columns for each option report closing price, trading volume, in contracts, and open interest bracket number of outstanding contracts. When we compare prices of call options with the same expiration date but different exercise prices in figure 20.1, we see that the value of a call is lower when the exercise price is higher. This makes sense. Well, it clearly makes sense to you, but not so much sense to me just yet. Because the right to purchase a share at a lower exercise price is more valuable than the right to purchase at a higher price. Oh yeah, this makes more sense because the right to purchase a share at a lower price is more valuable than the right to purchase at a higher price. Thus, the February expiration IBM call option with strike price of $195 sells for $3.65, whereas the 200 exercise price February call sells for only $1.61. Conversely, conversely, put options are worth more when the exercise price is higher. You would rather have the right to sell shares for $200 than for $195, and this is reflected in the prices of the puts. The February expiration put option with strike price $200 sells for $8.09, whereas the $195 exercise price February put sells for only $5. Why is that so? There's no data to back up that saying, or do they? Wait, let's take a look at the figure here. Oops. February expiration put price with strike price 200 sells for $8.09. Where is that option? Okay, so we have strike 200 volume blah blah blah. Okay, I do see the number 8.09. Never mind. Let's finish reviewing and reading this section first. Okay, so if an option does not trade on a given day, 3 dots will appear in the volume and price columns. Because trading is infrequent, it is not unusual to find option prices that appear out of line with other prices. You might see, for example, 2 calls with different exercise prices that seem to sell for the same price. 2 calls with different exercise prices that seem to sell for the same price. This discrepancy arises because the last trades for these options may have occurred at different times. This discrepancy arises because the last trades for these options may have occurred at different times during the day, at any moment. The call with the lower exercise price must be worth more than an otherwise identical call with a higher exercise price. expirations of most exchanged traded options tend to be fairly short, ranging up to only several months. For larger firms and several stock indexes, however, longer-term options are traded with expirations ranging up to several years. These options are called leaps. An abbreviation for long-term equity, anti passion securities. Long-term equity, passion securities. Yeah. And then we have concept checkpoint 20.1. A. What will be the proceeds and net profits to an investor who purchases the February expiration IBM calls with exercise price $195 if the stock price at expiration is $205? What if the stock price at expiration is $185? B. Now answer part A for an investor who purchases a February expiration IBM put option with exercise price $195. Okay, so yeah, that's it for this filming session, and I hope that both you and me have learned at least something worthwhile so far at this point. So thank you very much for being with me to the end of this video and filming session. And yeah, never stop learning, no matter the situation. If God's still willing, then until next time, au revoir. Thank you very much for watching and being with me to the end of this filming session. Take care, if God's still willing. Au revoir. Until next time, cheers. Have a lovely weekend. Take care, stay safe. Bye. Cheers. Amen. God bless.